Hey, good morning, everyone. Good morning. How's everybody? Hello,
Good
can you hear?
morning.
Hello, how you doing? I'm doing
Hi,
fine, Professor.
hi. Good morning,
Good
Jason.
morning.
Good morning, Natasha. Um,
Oops.
Jason, yeah, I saw your hand. I heard you. I saw your hand raised.
Yeah,
Yeah, go
that
ahead.
was
You
a
have a
big, that
question.
was a glitch.
Hmm? Oh, that was a glitch.
Yeah.
Okay.
I,
All righty. So I see. Let's see. I see 11 people. I see 11 people. And in today's forum, let's see how many people are in today's forum. I see only 9 people in today's forum, but I see 11. So in actually 12 people in the collaborate session. So if you haven't signed in, if you haven't signed in to the today's forum yet, please go ahead and do. Please do it first. Okay. Um, you gotta you gotta remember
Technically,
that.
there should be
Hmm?
there's one note taker in there, so
Yeah,
I
yeah,
don't
yeah.
think.
I understand. I understand.
Yeah.
But then the difference should be just one, but the difference is two. There are um, there are 9 in the forum, and then there are 13. There are 13. So the difference is 4. That means four people here haven't signed into the today's forum yet. But please remember, uh, I can't retrieve. I can only retrieve the list from here. I mean, uh, I cannot check attendance by replaying playing the video. Okay, so it takes too much time. So please report attendance here. Otherwise, you won't be marked present. All right. So I guess everyone understands that. So let's continue with from where we left off in the last class. Um, so in our last class, uh, we were I think we were about um, uh, we were talking about the direct cost. I mean, we stopped there, I believe. Let me quickly check our last where we stopped in our last class, which is okay. I believe this is your class, and which is the um, depreciation and okay, and the loss. If you think about it,
Profit lost.
because not expense, there's the revenue, and there can be no revenue without is leaving in the bank, keeping in the bank, savings account, or can all the past lectures can be found on uh, a kind of passive income, passive, right? So there are mainly 2 sources of income: sales revenue and investment income. Now we are out of time. Okay, so that was what we were just about to begin talking about the direct cost, and so just like income, remember, just like income, expenses are coming from 2 sources too, right? Remember, income comes from 2 sources, right? First, primarily sales revenue,
And then secondary source of income is passive income. Investment income being the major source of passive income. Now, and just like income, expenses come from two major sources. The primary source of primary source of expense or cost is direct cost. Okay, and then secondary source, or equally, I mean, secondary doesn't mean necessarily lesser in importance. Direct cost, some businesses have huge indirect costs, and that would be if a business has a huge indirect cost, it will be really a headache, because indirect cost doesn't directly contribute to the revenue. Now, first, let's take a look at the direct cost. Direct cost is so named, right? Direct cost is so named because this cost is directly changing with the production level, right? It means direct cost goes up if the production level goes up. Direct cost goes down if the production level goes down. Production level is the same thing as output, right? Output level goes up, direct cost goes up. Output level goes down, direct cost goes down too. Okay, it is also called cost of goods sold, CGS, cost of goods sold, and that's accounting's terminology. Cost of goods sold is accounting's terminology. But in microeconomics, it's called total variable cost, right? Now, if you think about it, I said direct cost is cold, so, right? It is so cold, right? Because it's moving like I said it is so cold because it changes with the production level, but also it is so cold, direct cost is cold direct cost because it is the cost of inputs. It's the cost of direct inputs of production. It's the cost of direct inputs, right? Or factors of production. And what are the factors of production? If you have studied the lecture videos, the main lecture videos, right? You should know. It should be clear to you. What are the direct inputs of production? Anybody? Now think about it. When you make something, if you're a manufacturer and if you make something, first of all, there must be what?
I would say material.
Yes. Of course, there must be raw material, right? Raw material.
Yes, raw material.
Yeah, raw material. Also, it is called, natural resource, right? Well, raw material comes from natural resource. So natural resource and raw material, that means the same thing. And in the old, in very old, traditional economics, it is called land because natural resources come from the land. Of course, that goes without, but forget about that. But let's call it raw material or natural resource. Yeah, but that's just one factor. That's just one factor. What are the other factors? Or what are the other inputs? You cannot, just because you have raw material, it just doesn't turn into a product, right?
Machinery as well.
Machinery, okay? Machinery, uh, in other words, broader terminology for that is plant and equipment, right? Plant and equipment.
Yes. Plant
Am I
and
right?
equipment.
Plant and equipment, or in a much broader terminology for that is capital. Capital, right? Now,
Yes.
capital sounds like money. Capital sounds like money, but uh, money is only a kind of capital. Money is money capital, and capital means originally what? Capital means means of production, right? You
Yes.
understand? Capital originally means means of production, something that serves to produce something, right? So, plant and equipment is physical capital, right? Is physical capital,
Yes.
money capital. So, yeah, capital. Uh, so we have raw material, we have capital, and is that all? I mean, unless,
No, that's
and
not all.
yeah, what else is needed? What else is
Um,
input?
Another input would be place. Place of
No.
production. No, no.
Well, plant and equipment is the play. A plant and equipment is set up on a place, right?
Maybe a website or platform.
Website would be a look. Website is not uh, website is not engaged directly in the production activity, right? Website can be used as a platform for marketing, right? Marketing and sale. I mean,
Right.
sale can happen on the website, but it clearly is not the input, right?
Right.
Raw material is input, capital is input. But what else can be the input or factors of production? What goes into a? I
Labor.
mean, you have, huh? Say that again.
Labor workers. Labor.
Labor. Yes. So was that Jason? Was that Jason who said labor?
That's me. That's me. Labor. Jason Camacho.
Okay, all righty. So, Jason, you gave me all three factors of production, right? You answered all three factors of production. So I will give you uh, 0, 0.75, okay? 0.75 for um, giving me all three answers. So today is 10:06. And you are fnb100 section 1100, right? All right, Jason, you got 0.75. Yeah, think about it. For any production, right? For any production, think about it. Be it manufacturing or agriculture or whatever, you have to have labor. First of all, you have to have raw material, labor, and capital, right? That goes without saying, right? That's without without even one, even without without even one of them, you can't have production, right? You cannot have production without uh, labor, right? Somebody has to be even if you have a fully automated uh, factory, someone needs to be there at the control panel, right? Even if it is
Right.
100% uh, fully mechanized, fully automated, right? Somebody has to be at at the control or at the dashboard, right? Behind behind the dashboard. So these are three factors of production, and direct cost means the cost of capital, labor, and raw material, right? Cost, labor, and material, right? So think about it. That's the direct cost. But again, it changes with the total amount of this. In other words, let's say capital, labor, and material altogether are $200, let's say. Um, and suppose that we are Dell computer, right? And to make Dell computer, we need raw material, we need capital, we need labor, and let's say it is $200, right? To make so that means it's a pure production cost, right? That is the production cost per unit, right? Let's assume that it's $200. And that $200 is literally direct cost because it's the cost of labor, material, and capital, labor, raw material, that goes into building 1 unit of computer. Hence, it's called unit cost, unit production cost, right? Unit production cost. Now, think about it. But the total direct cost means total of that, total. So that means if you build one computer, if you just build one computer, then your direct cost is $200. Isn't that right? But if you build, if you built 10 computers, then your direct cost is $2,000. It's 200 times 10, right? And if you built 100 units, then it's $20,000, right? Because it's 200 times 100, right? If you built 1,000 units, then the total of that in other words, direct cost will be $200,000. It's simply quantity produced. In other words, per unit is simply per unit production cost times quantity produced. Right? Isn't that right? Does that make sense? Everyone?
Yes, that makes a lot of sense.
Yeah, of course, to anybody with, to anybody with a, to anybody with common sense, it should make a lot of sense, right? And think about it. We know then, direct cost changes with the production level. I said we defined at the beginning that the direct cost is the cost that changes with the output level or production level, right? Then and I just gave you an example of how and why, because if the unit production cost is $200, then if you produce one unit, just one unit is 200, 10 units, $2,000, 100 units, $20,000, 1,000 units, $200,000, 10,000 units, $2 million, right? But if you produce 0 unit, what should it be? If you produce 0 unit, what should that be? What should be the direct cost?
Direct cost is 0.
Of course, it should be 0. In other words, it's perfectly commensurate, right, with the output level. It goes up and down with the output level. Hence, it's called direct cost. Okay, and then in microeconomics, it's called the total variable cost. Total variable. Variable means that it varies, right? It varies with the production level. Make sense? So we can. It also breaks down. Think about it. So total variable. If total variable cost is $200,000. We know that if we divide it by 1,000 units, that means we produced 1,000 units, right? So we divide it by 1,000 units. What do we arrive at? We arrive at back to the unit production cost of $200. Unit production cost of $200, right? If we produce, if the direct cost is, $2 million, direct cost is $2 million. And if we divide it by 10,000 units, we still arrive at $200. Of course, because $200 is the unit production cost. But then, the reason I divided it by the quantity produced, right? The reason I divided direct cost or total variable cost by quantity is to illustrate the concept of average. Isn't that right? When you divide total by the number, if you divide a total by the number, right? Isn't that average? Isn't that the concept of average? Isn't it right? Huh? We started with already average because per unit production cost cannot vary from one unit to another. I mean, it's industrialized, it's manufactured good, and the unit production cost cannot be different from one unit to another. It has to be the same thing. So we already started with the average production cost, right? But just to just to give you the illustration of the process, right? Why it is unit production cost is called average variable cost, right? Think about it. You're dividing total variable cost by the quantity, right? If you divide total variable cost by quantity, then you should arrive at average variable cost. Isn't it right? And average times quantity should be total. Everyone is following? Everyone is clear about that?
I'm clear.
Okay, good. Jason is clear. So everyone else must be clear as well. Everyone else must be clear. At least, I'm not, I know, I have proof here that I'm not shouting into a hollow cave, because at least Jason is, echoing back. So I'm not shouting into a hollow cave. Now I see 15 people, and I mentioned this previously. So I should see 15 here as well. Good. I see. Oh, this 15 means, okay, 15, that matches because we have Jessica here. All right, I have everyone. I have everyone in the today's forum as well. Okay, number matches. All righty. So where was I? Yeah. So average variable cost is another name. It's another name for unit production cost, right? So we can break total variable cost down to average variable cost times quantity. but it's quantity built. In this case, is quantity built or quantity produced or quantity made. Okay, however you call it, quantity built, quantity made, quantity produced. Now, but if you, by looking at this, we can, direct cost is sort of like a linear function. In other words, is average, as quantity goes up, right, total variable cost goes up, or direct cost goes up. And it brings, I believe we talked about the concept of definition of revenue in our last class. Revenue is also a kind of linear function of quantity. In other words, we defined revenue as price times quantity sold, didn't we? Remember that? I said, there is no better definition than mathematical definition, because verbal definition is always open-ended. Because of course we can make a closed-ended verbal definition too, but when I asked the students, you can't exactly, not everyone has a photographic memory, and of course most people don't have photographic memory. You can't exactly reproduce that well-defined verbal definition. So and then people tend to forget. So then sometimes, it comes out. Sometimes, some people just, blurt out something that is totally irrelevant. But, even among the people who who knows the concept of the revenue, still they come up with slightly varied versions, because everyone adds their own interpretation to that. So that's open-ended. And I told you, in science, open-ended answers are pariah. It belongs to pariah. Open-ended answers belong to pariah. That's not science, right? It may belong to the realm of literature, but it doesn't belong to the realm of science, because in science, if you use the same process, you have to arrive at the same result. If the outcomes vary every time, then that's not science, right? So that's why I don't like verbal definition. Nothing should be verbally defined. Everything must be defined mathematically. And a mathematical definition is always infallible, and it's indisputable, right? It's closed-ended, so it's infallible and it's indisputable. Okay? And so we defined, revenue as price times quantity sold, right? That's obvious. If they sell this computer for $300, right? Their production cost is $200 per unit, but if they sell it, but then they will sell it for $300, let's say, or something, greater than what their production cost. Then, if they sell 1 unit, their revenue is 300. If they sell 10 units, 3,000. If they sell 100 units, 30,000. If they sell 1,000 units, 300,000. 10,000 units, $3 million. If they sell if they sold 0 unit, then 0. So in other words, we can express revenue as a linear function of quantity, and also direct cost. We can express direct cost or total variable cost as a linear function of quantity. Okay, and then the only difference is this one is quantity sold and this one is quantity built. And think about it. If just because you built, let's say you built 1,000 units, right? You built 1,000 units. But is there a guarantee you can sell all 1,000 units? Well, sometimes you can sell 1,000 units. Sometimes you don't. Let's say so you sold only 900 units, right? Then obviously there's a difference between quantity sold and quantity produced, right? Um, but eventually, uh, that gap will be closed. That gap will be closed because think about it. If you produced 1,000 units and then uh, sold at $300, you sold 900 units at $300, right? So you have 100 units left unsold. But then what do? Can anybody tell me? Can anybody answer this question? Huh? You produced 1,000 units, but you could sell and you sold them for $300 per unit, but you could sell only 900 units. So you had 100 units left unsold. But if you had 100 units left unsold, what would you do? Anyone?
Um, let's see. I already haven't. I'd rather give it to the next person.
Okay. Anyone who can now, other than Jason, any? Yeah, Alisa, I see your microphone, but check your volume. Check your microphone volume. Looks like you have microphone on, but we can hear nothing. Alisa, your microphone is on, but we can hear anybody else.
I mean, based on the goods sold, right? I
Hmm.
would just get the I would just purchase
Okay.
the ones
Hold,
that I
hold,
did.
hold on, Jason. Hold on, because Alisa typed in her answer. Okay, I would put it on sale. Okay, Alisa said put it on sale. So put it on sale. Putting it on sale means what? What does putting it on sale means? We know you put it on sale. So what? That means what? In other words, if you put it on sale, that means. In other words, when you put it on sale, what does that mean? Hmm? If
I
you put
missed
it
that
on
part.
sale, what did Jason say? Yeah, Alisa, yeah, sell it for cheaper, of course. So, in other words, you will drop the price. Make sense? Uh,
Absolutely.
yeah, if 100 units are left unsold, then you will drop the price, right? Drop the price. You will reduce the price, drop the price. So you drop the price to 290, right? Some units will be sold, right? Hopefully, all 100 units will sell, but uh, uh, it may not. I mean, not all 100 units, but at least some will be sold, right? Because there are people who are who find it, um, yeah. So and then after that, then still some left, but then you drop the price to 280, right? So some units will be sold
Right.
then, and then still some left. Drop it to 270. In other words, you can drop the price until you exhaust all those 100 units. That makes sense. So, Alisa, I will give you 0.25 for that answer. Alisa. Um, yes. Of course, you cannot drop the price below 200. Right? Isn't that right? You cannot drop the price below 200. Okay, you can't. But um, as long as the price is above your uh, unit production cost, then you'll still make profit. So eventually, uh, because of that, eventually, quantity sold and quantity built and quantity sold will be equal, right? They will, in other words, market will clear eventually, right? Market will clear eventually. So now we understand that the revenue can be expressed as a linear function, and the direct cost can be, or total variable cost can be expressed as a linear function of quantity, right? Now, and I said cost of goods sold is the accounting's terminology, and in cost of goods sold literally means, okay, then that's cost of goods sold is not exactly cost of goods produced, right? Because as I said, quantity sold can be different from quantity produced, but eventually they become the same thing, right? The difference will be reconciled because you can drop the price to move everything out of your inventory, right? And then next is indirect cost, and indirect cost is also called operating expenses or OPEX. So here in the expenses column, right? In the expenses section, CGS is the conclusion of direct cost. In other words, cost that's directly related to production. And I told you these line items are not exactly matching the example my explanation, because my explanation is based on manufacturing, and this one is very typical of retail. But I'm gonna get to that later. And then the expenses that are unrelated to production, unrelated, right? So the line items, are basically the expenses unrelated to production, which are rent, utilities, salaries, depreciation, R&D expense, and marketing expenses. These line items, forget about these, minor line items. It's more important to understand why it is indirect. Of course, it is indirect cost because it's not directly related to production. It's mostly unrelated to production, and at best, indirectly related to production. Indirectly related to production. And these line items are exactly like those. For example, suppose you are running a coffee shop. I mean, let's move, let's change our business slightly from computer manufacturing to a coffee shop. And suppose you're running a coffee shop, right? You must be renting that space, right? Your coffee shop, unless you own the building, right? You must be renting the space. So you pay rent, right? But think about the rent. Does the rent rent is a fixed cost, isn't it right? It doesn't change. It doesn't
Yes.
depend on your. It doesn't depend on your revenue. It doesn't depend on your production level. So,
Not
for
unless
example,
not unless the landlord is asking for more, after X amount of years.
yeah, but that doesn't that has nothing to do with your production level, isn't it right? Does the
Right.
landlord demand more rent, higher rent, when when your production level is high? Huh? No, I mean,
No.
landlord can, when I say landlord can raise the rent, uh, a certain, like 5 years later, a certain, when you, renewing the contract or whatever, but it has nothing to do with the production level. The point is, whether it is fixed or not, how to determine whether, whether it is fixed or not depends on, um, you say whether it is fixed cost or not based on whether it's changing with the production level or not. Okay, that's the criteria. So think about it. In case of a coffee shop, um, if your business is doing, if your business is thriving, for example, on average, let's say on average, your on on an average month, your average sale, let's say you sell only one type of coffee, right? One type of coffee. Uh, let's say you sell, um, uh, what,
Let's say
some
both.
uh, flavored Americano. That's the only thing you sell. Of course, if you sell Americano, you can sell espresso, but ignore all that. Let's say you sell, let's say what, blueberry flavored Americano. Oh, only that, and that's $5. Let's say it's $5. So then, on an average month, in an average month, you sell, your revenue is, and it's $5. So you sell like 10,000 cups, right? 10,000 cups of, Americano, right? Blueberry Americano, 10,000 cups. Then on an average month, what is your revenue? What is your average revenue? Hmm? You forgot the setup already. I said you sell this for $5, and on an average month you sell 10,000 cups. Then how much is your revenue?
50,000.
Yeah, 50,000. Yes. Yeah. Who said that?
Gerard.
Gerard. Okay, Gerard. Okay. You got 0.25 for that answer. Yes, it's quite obvious, isn't it right? So your average revenue on an average month, right? Your average sales revenue, right, is 50,000. How much is the rent is, let's say whatever the rent is, yeah, let's say the rent is, 5,000 rent. Now, good month, not average month. This month has been particularly good. You sold 20,000 cups of this blueberry Americano. 20,000 cups. So what's your revenue? What's your revenue? Hmm?
It should be.
It's simply 5 times 20,000, isn't it right? Five
Right,
times
5 times
20,000.
20,000. Yeah.
So then what is it? Hmm? Look, Gerald just said a while
100,000.
ago.
It'll
Yeah,
be
Gerald.
100,000. We both
Okay,
said it at the same time, so I'll give Jared the credit though.
alrighty. Gerald, so you got another 0.25. Look, uh, yeah, you don't have to do the math again. Why? Because uh, the sale just doubled, isn't it right? The sale just doubled. Jared said a while ago it was 50,000 on average month if you sell just 10,000 units, right? That is, 50,000. But this month the sale doubled, right? Simply, from 10,000 to 20,000 units, right? So sale doubled. So then, it should be the double, 2 times the average month, right? 2 times the average monthly sale. So then, 50,000 times two, we can all come to 100,000. Gerald, you got another 0.25 for that. Um, But so the sales this month revenue is 100,000, exactly double of regular month, average month. What is the rent now? What is the rent? It's still the same thing, isn't
It's
it
still
right?
same thing, right?
Yeah, of course. Just because you had a good month, good business, the rent doesn't go up. Or another month, this business was very bad. You could sell only 5,000 cups of coffee. 5,000 cups of coffee. And
It's
what
still
is your revenue?
it's still five
Yeah,
thousand.
yeah. Rent is still 5,000, right? The revenue is half. Revenue is half. So revenue is then 25,000, but still the rent is still the same thing, right? So rent is exactly the example of fixed cost, right? And fixed doesn't mean it will never. Fixed cost doesn't mean it will never change. The landlord can raise it at some point, but whether landlord raises it or not doesn't depend on your production level. Okay, you have to keep it very. You have to make it very clear to yourself. Direct cost is called direct cost because it's also called total variable cost because it varies with the production cost. Whereas indirect cost is called total fixed cost, and because it's fixed. In other words, it's constant and it doesn't change. It may change sometime. It may change, one day, but the cause of change is not the production level. It means, it doesn't change with the production level. And so rent is one good example. Another example is um, if this is manufacturing, right? There are two types of workers. You have two types of workers. Now, let's get back to the uh, let's go back to the computer manufacturing example. Um, any manufacturing, any manufacturing business will have two types of workers, right? Type one, is of course production workers, workers that are directly engaged in production activity, workers that are directly working on the assembly line, right? Workers that are directly working on the assembly line. That's uh, and then second type of workers are administrative or clerical staff, administrative staff or clerical staff, right? And then think about it. Suppose on an average month, right? Uh, let's say Dell makes 10,000 computers. Dell makes 10,000 computers, right? On an average month. So their unit production cost is $200. So then, on an average month, they're because they make 10,000 um, 10,000 units, then their total variable cost or direct cost will be $2 million. Isn't that right? 200 times 10,000, $2 million, right? Now, but this month, suddenly, this month there is a surge of demand. There's a surge of demand, right? There's, like, so the demand has doubled. Demand has doubled, right? That means, this month, this particular month, um, 20,000 units is the production level. You have to produce, 20,000 units. Then if you have to double the production, then what do you have to do? If you double the production, everything, all the inputs must double, isn't that right? All the inputs must double. The raw material must double, labor must double, capital usage must double, right? Now, raw material will, it's not difficult to double the raw material as long as there's no raw material shortage, right? As long as there's no raw material shortage, we can double the raw material and we can double the usage of capital, right? It's just the time. We run the machine, twice the time, right? And labor, it's a little difficult thing because there are two things you can do. You can double the hours. You can double the hours of these workers, production workers, or double the number of them. You understand, right? All the inputs must double because if you double the production level, all the inputs must double. But labor, because labor is a human factor, the easiest thing is, you may think, can you not just double the number of workers? Yes, you can do that, but companies generally won't do that. What the companies would want to do is double their hours, right? Why? Well, in manufacturing, something like, think about it. Anybody, in your family or anyone around you working on automaker, auto manufacturing, factory, auto plant, like auto manufacturing plant, like GM or Chrysler, you would know they are skilled workers. They are skilled labor. They are not unskilled labor, right? They have to be trained first. It takes like at least 6 months to 1 year. They must be trained. They must be skilled until they are working proficiently in their even go to a garage, or you think someone will just start. If you work as a mechanic, do you think? I mean, mechanic is clearly a trained, skilled labor. You don't become a mechanic just, you cannot just pick someone from a street and, make him, put him to work as a mechanic, right? And that's what is happening with, auto manufacturing plant. You can't just, put anybody. So that's why it's hard. It's not possible to just double the number of workers overnight, right? Because if you cannot have unskilled labor, right, in manufacturing, and if you can hire a skilled worker, that means they must be. It's not likely, because if they are skilled workers in auto manufacturing, then they must be hired by they have permanent jobs with other automakers like, Chrysler or GM. I mean, if you're Ford, they have. So basically, they cannot double the number of workers. So most likely the company will make their existing workers work double time, right? Of course, they have, they get, they get extra pay. Their pay will be doubled, and if their pay is doubled, then they will, they will be willing to work double time, right? But again, the workers are human beings. There's a limit, physical limit to, normally they work 8 hours a day, but, doubling their hours means 16 hours a day. Can they work this double shift? I mean, it's not exactly double shift, it's not even a shift, it's just working twice. For about a week, or maximum 2 weeks, maximum of 2 weeks, they may be able to put in 16 hours per day, and they are, willing to do that because double pay. But then by the third week, they will start to collapse, right? They will start to collapse. So usually, what they do, if they double the production level, the machines can run, double time, right? Machines can run double time. Raw materials can be doubled, right? But the labor, physically, either the hours must double or the number of workers must double. But most likely the hours will double. Okay, but either way, we'll have to assume that the either doubling the number of workers is possible. I mean, and doubling the hours or doubling the hours is possible without any constraint. And in reality, it will be some combination of the two. First of all, the management will ask the workers to work double time for double pay. But then, since they know people will collapse after a certain amount of time, then what they do is they will actually get some skilled workers. But where do they find skilled workers? They will contact the alumni. In other words, retirees, the ones who were, because this is only temporary, isn't it right? This is only temporary. The demand surge is only temporary. It's not permanent. So they cannot hire, if they hire extra people, it's only on temporary basis. And in that case, they will have to go to the retirees who are, retirees, if they are willing to, they are enjoying retired life, but they may still be willing to work for a good pay. So usually, retired workers, it doesn't have to be the retired workers of the General Motors. It could be from, if you are General Motors, you could get retired workers from the same industry, right? Regardless of what company they worked for in the past. So this is, what actually happens if the demand doubles, right? If the demand doubles, the production level, production must double. So either the number of hours or the number of workers must double, and then that's because the demand doubled and the production level doubles. The production level will also double. So it's variable cost. It's clearly variable cost, and the workers on the workers that are directly engaged in production, the workers on the production line, they will have to double. But on the other end, I said, there are two types of workers. One, production workers who are directly engaged in production activity. The other, administrative or clerical, right? Administrative or clerical. Now, secretaries are a typical example of clerical staff, right? Secretaries, right? Now think about it. When the production doubles, when the production level doubles, do we need to double the number of secretaries? Or do we need to double the hours of secretaries?
I think we need to double the hours of the secretaries.
No, why?
No. I answered too quickly. I meant to say. Never mind.
No. Look. The logic is very clear here. How the logic. This is the logic about what is variable cost and what is fixed cost, right? Variable cost is so called because it varies with the production level. And the number of production workers or hours of the production workers must also double if the production level must double. But the hours or number of secretaries, does it change with the production level?
No.
Think about it. Secretaries are not engaged in production activities, right? They are not working on secretaries are not working on the assembly line.
No, they're
So
not.
the production doubles. Why does the secretaries, do we need to double the number of secretaries, or do we need to double the hours of secretaries? No, absolutely
No.
not. They are not directly engaged in production, so they are not part of the variable cost. They are part of the fixed cost. You understand? Right? Of course, secretaries might need to work a couple of more hours because the company is busier now, right? The company is more busy than usual because the production level has gone up and production level is doubled. So secretaries might need to work a couple of more hours. They may need to put in a couple of more hours, but it doesn't go up in direct proportion. It doesn't go up in direct proportion to the production level. You understand? There's no direct proportion. All the direct factors of production, capital, labor, raw material, they move in tandem. They move in direct proportion to the production level, but number of hours or number of secretaries, hours of secretaries or hours of number of secretaries don't change or move in tandem with the production level, right? It doesn't change in proportion to production level because they are not directly related to production. All administrative staff, for that matter, all clerical staff. Secretary was just an example of clerical staff, but all clerical staff, and think about it. Here, these salaries are basically base salaries, and base salaries for on an average month, base salaries for production workers will be relatively a constant one, right? But if the production level goes up, but these salaries, are reflecting either in a base salary or just the salaries of the clerical administrative staff. Now, our marketing expense, R&D expense, they are relatively constant because they are not directly related to production level. You might think isn't R&D directly related to production? Yes, of course, R&D is related to production, but not the output level, not the production level. Whether production level is doubled or not, it has nothing to do with R&D. R&D is separate, right? R&D activity, right? R&D will be conducted regardless of whether the production is 10,000 units or 20,000 units, right? Marketing will still be regardless of the production level. Marketing budget comes from marketing budget is some part of the percentage of the sales revenue from and that was already from the marketing budget is already earmarked from marketing budget is funded by the revenue from last year, right? Revenue size of the revenue from the last year, because this year's revenue we don't know yet. We have target, but we don't know yet. It's not a concrete number, right? Because until this year is over, we don't know. So regardless of current production activity, right? Current production level, marketing is independent of that. So all of those are operating expenses, which are fixed cost or indirect cost. But the fixed cost is not exactly the same thing as operating expenses, right? Because fixed cost, the focus of the fixed cost is a little different. So I'm going to have to take a break at this point because it's 12:00. What was the time? It's 12:08. So we are well past the time to take a break. So we're going to take a 10-minute break and reconvene at 12:19, right? We'll reconvene at 12:19, and I'm going to talk about why total fixed cost is slightly different from operating expenses. Okay? All righty. So then let's take a 10 minutes. All right, we're back. We're back. So, before I left, I said I would talk about total fixed cost upon coming back. So, total fixed cost, uh, it's microeconomics terminology, just like total variable cost, and as opposed to total variable cost, literally, fixed total fixed cost is not changing with the production level. So it has nothing to do with the production level. So it generally refers to the uh, operating expenses, OPEX, like rent, utility, and things like that, but which are fixed, which are in other words, not changing with the production level, right? They may change someday. I mean, utility can change, I mean, um, uh, if you're heating, if you're air conditioning more, if you're heating more, obviously utility will change, if you're lighting up the building more, but uh, it doesn't have anything to do with the production level, right? It may have slight, connection with the, of course, if you produce more, you need to light up the building more. But regardless, uh, uh, the the heating and cooling and all these things are not directly related to the production level. Um, uh, Rent doesn't, but then from microeconomics perspective, the focus is more on the initial investment, right? Uh, think about it. For a manufacturing, right? For a manufacturing, um, there you must manufacturing must have plant and equipment to begin with, right? There can be no manufacturing without plant and equipment. And the plant and equipment, and before you start any production, it must be in place. So that means you need to you need to construct. You need construction. You need a construction of plant and equipment, construction of the plant, and then you gotta, then once the plant is, completed, I mean the factory building is completed, then you must um, uh, put in the production equipment, manufacturing equipment into the building, into the factory. So even before starting any production, right, you must invest the startup. You must invest in the plant and equipment, which is called startup capital. Your startup capital must be at least your startup capital must be at least uh, uh, equal to or greater than the cost of cost of building plant and equipment, right? And then think about it. Um, this whether uh, that's already um, that's already an investment of like tens of millions of dollars, right? Plant and equipment won't cost just of $1,000, right? It will be like tens of millions of dollars, sometimes even hundreds of millions of dollars, right? And without any sale, I mean, before selling anything, first you cannot sell anything because you haven't made anything yet, and you haven't made anything because there must be the plant and equipment first, right? So this investment is a until in other words, you gotta sink your initial investment or startup capital into this business. You got to sink it into this business even before starting the production, even before starting. So this capital, if it is like, tens of millions of dollars, that's called also sunk capital, right? Because it is sink into this business, right? And you have to, while this plant is being built, right? It may take a year or 2 years. It may take 1 or 2 years, maybe more, but most like, they cannot. Um, um, but think about it. For 1 year or for 2 years, you just incurred cost. You just incurred this cost without any return, without any revenue on it, right? Without any revenue. So manufacturing requires that kind of commitment of capital, right? And you have to wait. You have to, once you have invested this, capital, startup capital into it, um, you have to be patient, and wait for the completion of the plant, and then wait for the first batch of output, first batch of products to go on sale and go for sale, not on sale, to go for sale and sell and bring in the revenue. Of course, the first round of revenue cannot recover. First round of revenue cannot recover this initial investment because first round of it costs like tens of millions of dollars. First round of sale, first round of revenue cannot be tens of millions of dollars. It may take at least, it may take a few years, like 5 years, 7 years, it may take at least like 5 years for you to fully recover this initial investment. Make sense? So that is the difference, major difference between manufacturing and retail. Of course, there's a huge barrier, big, entry barrier to manufacturing because, of course, you can. When we say manufacturing, there can be low level, low tech, and high tech. Low tech manufacturing is something like making paper clips. Think about it. Making a manufacturer of paper clips, what kind of technology does it require? I mean, and how much, startup capital does it require, right? The entry barrier is very low for paper clips, something like a paper clip or rubber band, but something like, an automobile, a computer, or mobile device, the entry barrier is very high. Meaning, you have to have that technology, first of all. You must have the technology, and then you must have that capital, startup capital, right? It would be, hundreds of millions of dollars if you are building an auto manufacturing plant, or mobile device, like mobile device, like mobile phone, smartphones, so it will take years to recover the initial investment, plus, sufficient return on it, right? But retail, think about it, retail has relatively low entry barrier. It doesn't require technology, high tech, first of all. A retail, even mom and pop store is retail, right? Not a, like a giant retail like Amazon. Of course, a mom and pop store is being wiped out by Amazon. But the point is, if even the hole in the wall store, I mean, even there was actually in the third world countries, there's actually, really a hole in the walls store, right? They just put a hole in the wall and they sell. That expression, still exists, in that hole-in-the-wall store, that expression still exists in reality in third world countries very often. Retail, retail doesn't require huge startup capital because there's no plant, there's no equipment. All you need is just as long as you can lease a space, right? And all you need is just stock it up with merchandise, and then so you can easily set up and you can easily close it. You can easily close it down. Retail business can easily close. You can easily open up and easily close down. I mean, you don't have any permanent, real estate like plant. You can simply, run the business, while while you're paying rent, and then so sometimes there are some, pop-up stores like that, just open up, one day and just close, close out one day, and a big discount sale, especially clothings, apparel, clothings, there were many like pop-up stores like that in warehouse. They can just rent a warehouse space, and they just stock it up with clothes, and because it doesn't cost it doesn't take that it doesn't cost startup capital or huge startup capital like manufacturing. They can easily set up, they can easily pop up and easily close down. Now, so we have come to then a full explanation of all the sources of income, right? Two sources of income and two sources of expense. So then the next is what? Obviously, when we have all the expenses listed and all the income listed, then what comes next is subtraction. You subtract, right? I ask this question over and over again, and the students hardly come up with the correct answer. I always ask, so we have income and we have expenses. What is the next course of action? The next course of action is subtraction. What?
I mean, well, subtracting then the balance sheet, I guess.
Subtracting the balance sheet. No balance. Look, we are talking about income statement, and balance sheet is a separate statement. You cannot subtract balance sheet, right? It's a separate statement.
Right.
I've been telling you what happens next is subtracting the expenses from income, right? You have to subtract the expenses from income, right? And it's all etched in our human DNA. I mean, if you see income, I mean, even a child, let's say, a 5-year child, or let's say, a 10-year kid, or 80-year-old kid, or third grader, they may not know the concept of income and expenses, but as long as they know this is money coming in, right? As long as they understand that this is money coming in, money that came in, and this is the money that has to go out, then even a third grader would understand that this must be subtracted. Money going out must be subtracted. Money to go out must be subtracted from the money received. Right? That's
Yes,
I
that's
think
true.
it's an instinct. As long as we are human, human race, right? It's etched in our DNA. It's just by instinct we know that if this is money to go out and this is money coming in, then we know we have to subtract, right, the money to go out, right, from money coming in. So the word is subtract, and I asked this question to students over and over every semester. What is the next? We have income now, all the income listed and all the expenses listed. And I asked the students, what's the next course of action? Then they all come up with all these, irrelevant, just you're trying to like you're just fumbling in the wrong area. You're just everyone is fumbling in the wrong area. It's very simple and straightforward. The word is subtract, to subtract. Word is to subtract. You will subtract all the expenses from income. And that's unless you have an alien DNA, right? And if you have an alien DNA, maybe you might, your instinct may be different. But, for every human, being, if you have money coming in, money going out, your instinct tells you that to subtract money going out from money coming in, right? And then we arrive at operating income or operating profit, right? Now, roughly, we all understand income minus expense, roughly that's profit. But then it's not, we have to be careful here. Profit it's just a rough concept. Correct term is operating profit or operating income, right? Because there's net profit also, but net profit, we are not at net profit here yet. This is called operating profit or operating income, also called EBIT, earnings before interest and taxes. Now, the term earnings before interest and taxes, it's already self-explanatory or self-predicting. Because it says it's earnings before interest and taxes, then it already implies that what comes next is interest. In other words, it's before interest and taxes. That means you will have to pay interest and you will have to pay taxes, right? You will have to pay interest and you will have to pay taxes. But only after paying interest and taxes, then you arrive at net profit. So until then, you cannot call it net profit. Just you shouldn't even call it profit. You should call it operating profit, okay, or EBIT, to be very specific, because EBIT is very specific. This is the earning. So earning is the same thing as profit. Earning means the same thing as profit. Earning is the same thing as profit. But is profit the same thing as income? No, I won't say. Why? Because income is here. This is income. In other words, income means gross income. It's the gross state. And once you have subtracted all the expenses, it shouldn't be called income anymore. But in accounting, they keep that term income. And I'm gonna tell you next time why they still keep earnings before interest and taxes means from this you'll have to pay interest and you'll have to pay taxes. Now paying it, why do you pay interest? Because you borrowed. Think about it. Where did the startup capital of tens of millions of dollars come from? The startup capital comes from one of the two sources, either of the two sources. I mean, both, most of the times from either equity or debt, right? Equity or debt. but it's not one or the other. It is, some combination of the two. So, so let's say the startup capital was, $50 million, $10 million, $10 million. Startup capital was $10 million, just to make it simple, $10 million. Theoretically, you raise the capital from the investors. But look, if you're a startup business, if you're a startup, who will invest? Who will invest in you? You are a big question mark. You have no track record. You are just, you have just, a wild idea, How do you know, you say you have technology. How do you know that technology will work? Right? So, startups have very hard time raising capital. But let's say, so now you don't have any investor. It's hard to get an investor. It's hard to borrow from the bank. But let's say, ideally, you got investors and, you were able to get a loan from the bank. If you got a loan from the bank, then you'll have to pay interest, right? For any debt. So you have debt because of the startup capital, right? And for that, you have to pay interest. And then after paying interest, then it becomes EBT because, from EBIT, I falls out, right? I drops off because you paid interest, then it's EBT. Then it's earnings before taxes. Earnings before taxes, another name for that is taxable income, because now there's earnings before taxes. That's exactly the taxable income. So you pay taxes. And then after paying taxes, then since you have already paid taxes, then this becomes EAT, earnings after taxes, which is now net profit. Okay. Now I had to rush it because we are out of time. It's already 12:43. Now, so I will, revisit this. There's more to talk about. We haven't even covered balance sheet, but again, this is not the main lecture. The main lecture has already covered everything about the financial statements. So you are ready to take this quiz 1 this weekend. Okay. All righty. So that's it for today. I will see you guys next Monday. Have a good rest of the afternoon, and I will see you Monday. Good luck with the quiz 1. Okay. All right. I'm going to stop sharing and stop recording and sign out. All right.
Thank you very much,
All right,
Professor.
thank you, Professor.
All right. Goodbye, everybody. I'll see you.
Thank you,
next.
Professor.
Have a good one.
All right. You too.
Have a
You
great one,
too.
Professor.
All righty. Take care, everyone. Stop.